If you look at the debt clock in Times Square today, you will see a number that defies human comprehension, currently spinning past 35 trillion and heading toward 38 trillion. For decades we were told this number didn't matter, but in 2024, the math changed. For the first time in history, the US government is spending more on interest payments than on its entire national defense. According to a report by the Coin Financials, the US is not going to pay this back with taxes. They are going to use a soft default, printing the difference and erasing your savings through inflation. But there is one thing keeping this house of cards from collapsing: oil. Today, we reveal the hidden architecture of the petrodollar, the two conspiracies that led to war, and how the financial sector is quietly liquidating the middle class. Now we'll show you everything you need to know. We'll explore why every US war in the last 50 years has a direct link to the survival of the dollar, as noted in recent software and tech reviews on codingm.com regarding AI's ability to analyze these complex narratives. We'll uncover the Cantillon effect, explain the secret gold seizure of 1933, and look at the end game currently being built in the basement of the Federal Reserve. Stick around until the end because the solution to this crisis isn't what you think. It's about asset survival. To understand the why behind US wars, you have to understand the petrodollar. Since the 1970s, most oil has been priced in US dollars, creating a built-in captive buyer for the dollar worldwide. Energy needs dollars. 1973 to 1974, after the oil embargo, Washington and Riyadh strike a simple bargain: price oil in dollars. In return, security guarantees and market access. No signatures on screen, just the terms. That agreement hardwired dollar demand into energy. If you want energy, you must have dollars. That lets the US export inflation to everyone else through the oil pipeline of trade. Then comes recycling. Oil exporters earn dollars and park them in treasuries and Wall Street. Dollars out for oil, dollars back for US debt. A closed loop that funds deficits quietly. Complex? Let's use a metaphor. Imagine a global gas station with one cash register, only dollars accepted. Everyone lines up with dollars before they can fill up. The US government is like a household paying one credit card with another. Rollovers, balance transfers, repeat. That is the debt spiral. A quick example. Spend $120, take in $100, borrow $20 at 3%. Next year, refinance at 5% as rates rise. Interest grows, the balance climbs, and the cycle tightens, unless cheap funding persists. As long as oil is priced in dollars, the world must hold dollars and lend them back to the US at suppressed rates. That global dollar demand pushes treasury yields lower than they'd otherwise be. Your mortgage is cheaper, asset prices are higher, and deficits feel painless on the surface. If that oil-to-dollar link breaks, if barrels price in multiple currencies, the dollar's captive demand thins and the global banking plumbing seizes. Fast. That's the hinge. Currency rails decide who can borrow cheaply and who can't. Next we follow the new money as it enters the system first, the Cantillon effect. The Cantillon effect in one line: new money enters at the center, benefits the closest recipients first, and only later raises prices for everyone else. Step 1. Treasury issues new debt, primary dealers buy it, the Fed stands behind the system by creating bank reserves against those treasuries. Those reserves travel through simple pipes, repo loans for short-term funding, and QE that swaps bonds for cash. Later, QT drains some back, but the early wave reaches Wall Street first. Early receivers, big banks, hedge funds, and large corporations buy assets before prices move. Stocks, real estate, commodities. Then comes the lag. Businesses raise prices, landlords adjust rents. Only after months do wages catch up, if they do at all. Who wins? Asset owners, leveraged borrowers with fixed rates, and the financial sector. Who loses? Savers in cash, wage earners on fixed salaries, and retirees on fixed incomes. That gap is the engine of the Cantillon effect. A simple example. Milk, $3 becomes $3.60. Rent, $1,500 becomes $1,725. Your raise, 8%. Months later, you're still behind. Picture the flow, central bank to banks to markets to businesses to you. Each hop takes time, each hop adds fees and markups. By the end, your paycheck buys less. Now ask, what happens if that pipeline is threatened? If oil stops clearing in dollars, the early receiver advantage breaks. And that takes us straight into our first conspiracy. This brings us to a widely discussed theory. Some economists consider it plausible, others reject it. We present it as a disputed interpretation. Timeline. Year 2000. Under the UN Oil for Food program, Iraq announces euro pricing for its oil exports. Implementation begins gradually pending approvals and contracts. The claim, invoicing oil in euros, if adopted widely, could shift baseline demand away from dollars. Less structural dollar demand means higher funding costs for Washington. Mechanism, simplified. Oil buyers source the billing currency. Central banks hold more of that currency as reserves. Global finance deepens around it. Network effects snowball. Reactions at the time were mixed. Markets noted the headline. Policymakers emphasized sanctions, compliance, and broader security concerns. Official statements avoided currency motives. Analysts flagged a risk. If OPEC members copied euro invoicing, dollar liquidity in energy trade could thin, pressuring U.S. deficits and the debt machine. 3 years later, the U.S. invaded Iraq. Official rationale, weapons of mass destruction and security concerns. The theory argues the euro-denominated oil experiment threatened dollar hegemony. Many dispute this, citing security and geopolitical aims as primary drivers. Incentives matter. Commodity sellers choose invoice currency for liquidity, depth, settlement speed, FX hedging costs, and sanctions exposure. The deepest pool usually wins. Bottom line, whether Iraq's euro pricing influenced events remains an open question. What's clear is the leverage that invoice currency confers. Next, we examine how states respond when that leverage is at risk. When a government gets truly desperate, it stops being subtle. In 1933, President Franklin D. Roosevelt signed Executive Order 6102, ordering Americans to turn in most gold to the Federal Reserve, under penalty of fines and up to 10 years in prison. In plain terms, citizens had to sell their gold to the government at a fixed price. Jewelry and small amounts were exempt, but hoarding coins or bullion became illegal. Compliance was the point. After the gold was collected, the official price was raised from $20.67 to $35 per ounce. Translation: the dollar was devalued. The same ounce now bought more dollars. Savers absorbed the loss. Think of a scale. The ounce stayed the same. The measuring unit changed. That is how inflation, quietly, transfers purchasing power. Why do governments act like this? Crisis math. In a deflationary spiral or banking panic, debts become heavier. Policymakers choose tools that preserve the system, often at the expense of savers. Modern example: Cyprus, 2013. Banks failed. Depositors above set limits took bail-in haircuts. Private money used to recapitalize the system, not theory. It happened. Capital controls followed. ATM limits, withdrawal caps, cross-border transfer approvals. Access, not just ownership, became the choke point. Today, digital assets add a twist. If your coins sit on an exchange, you hold an IOU, subject to terms, rehypothecation, and freezes. If your keys aren't yours, your custody isn't either. Practical note, not financial advice. Understand custody, read platform terms, expect withdrawal delays and stress, and avoid single points of failure. Resilience beats prediction. And this is why CBDCs matter. Programmable money makes policy surgical. Rates, freezes, even spending windows, enforced by code. The next chapter shows how that lever works. A CBDC is central bank money in a programmable, app-based form, digital cash issued by the state. Unlike cash, it can settle instantly and carry rules in the code, programmable limits, negative rates, even expiry dates. In pilots of the digital yuan, people use phone wallets and scan QR codes on buses and in street markets. Fast, low-friction payments. The upside: faster payments, lower fees, fewer scams, and real financial inclusion for people outside the banking system. The risks: pervasive tracking, detailed spending profiles, and the ability to block or steer purchases at the flick of a switch. Proposed safeguards: tiered wallets with low-value privacy, offline tap-to-pay cards, and privacy-preserving cryptography. Picture a downturn. Policymakers toggle stimulus, -1% on idle balances, groceries whitelisted. Policies propagate to every wallet within minutes. That's the endgame. Design equals destiny. Next, the silent eraser already shaping your savings. The verdict is clear. The US government is not going to default, it is going to inflate. This is the silent eraser. If your money is in a savings account earning 4% while real inflation is 8%, You are the donor class paying off the national debt. As Justin Cheung notes in his guide on high-impact storytelling, a meaningful journey must leave the audience changed. You can no longer save your way to prosperity. You are now in a game of asset survival. If you want to know which assets the government cannot print and how to protect your 401k from the next emergency order, subscribe and hit the bell icon. According to ABCD guidelines from Think with Google, I should remind you to take action now. Comment below, is the dollar's reign over? Or is this just the beginning of a new era? I'll see you in the next one.